The housing shortage myth is collapsing in front of us. The media can no longer get control of it because of the data I'm going to show you in today's video. It is already worse than 2008 when you're looking at various sources of information. Let's dig into all the real estate information that you need to know so you can make an informed decision if you're a buyer, seller, or investor, especially if you're in the Sun Belt, because things are changing really quickly. First thing off is that the monthly U.S. new single-family home sales have dropped significantly, and this is a huge story because we're in the middle of busy season. Typically, May is one of the best months of the year, May, June, July, right after people get their tax refunds back in February, and right before school starts in August. This is what we call busy season. Well, this busy season isn't so busy. You can see here it dropped to 51,000 for new single-family home sales. Well, this is important because these new home sales and these builders are offering massive incentives, and I'll show you the information of how much incentives you can actually get by buying one of these products today. So look, here's the big story. If you go all the way back to 2008 in May, it's at 49,000 sales. We're at 51,000 sales. It's not that wide of a gap. We are seeing weakness going into busy season, so you should expect going into the end of the year, it's going to be a lot tougher for builders. You're going to be able to negotiate way more, especially going into September, October, November. That's when a lot of the builders' year ends are, and they offer massive incentives. If you need a top agent in your area to be able to walk you through on how to save a fortune working with these builders, reach out to me. You can always email me. I'll get you in touch with a top real estate agent. 80% of the agents don't know anything that they're talking about. It's the top agents that really know how to drive value for their customers. Let me know, but we expect this trend to continue to create weakness. And, these new construction homes are competing with existing homes, which have been flat for the last few years as we saw mortgage interest rates increase. So this is a huge story because, again, this is what it's looking like even with the $50,000 rate buy downs from the builders. And this is from Bill McBride. If you haven't followed him on Calculated Risk, he's a great housing analyst. He called the 2008 crisis, but he's saying new home sales decreased to 580,000 annual rate in May. It's very low. And the part of the issue is that the builders overbuilt, especially here in the Sun Belt area. They just built way too much inventory, and they expected the migration trends to continue, and they have since reversed, where even in the state of Florida, we used to have 300,000 people have in net migration to Florida. Now we're just about even at 22,000 net migrants to Florida in 2025. And so the builders just completely miscalculated the amount of demand that they had, and then that caused them to have a glut of supply that we're seeing across the board. This is leading to lower prices. You can see that Lennar, imagine being that buyer in 2022 that bought the house for 491,000, and there's phase 2, phase 3, phase 4 across the board that's coming through, and now your house is worth, after net incentives, more than $100,000, $120,000 less. So there we've seen a 25% drop in 4 years from Lennar. We're seeing this from other builders as well, and the builders are starting to freak out, saying, where are these buyers? Why aren't they buying this new inventory, and what are they doing? And so they have to respond first with financial incentives because they don't want to drop the price. The price is the last thing that they want to focus on, and then they do the financial incentives first, and now we're starting to see the price cuts come because they are getting desperate from across the board. So we are getting pitched this housing shortage lie from the media. I've been to so many conferences, these economists and experts, hey, we have a shortage. This is a complete BS. This is just not even close to reality. What we had was a demand shock. And I know we don't have a shortage because in 2019, we didn't have a shortage of homes at all. What happened was we had a demand shock in 2020 from ultra low interest rates that caused a ton of speculation and a ton of migration from the North and the West to the Sun Belt areas. And that's for various political and obviously health reasons and other reasons and things like that. I'm not going to get into here, but that demand shock caused the builders to go crazy. And now that demand shock that pulled forward 10 years of demand into 3 years has now created a gap of demand. And so the builders are freaking out. So you see new single family homes. This comes from the U.S. Census Bureau. This red line here, month supply of current rate of sales. We're already above 10 months of supply of inventory for new homes. How can you have a housing shortage when you have 10 months supply of new homes? And you can see new single family houses sold continues to move downward. So this is the story that's actually happening, not the media lie narratives that are basically paid for media by title companies, mortgage companies, builders. You have to understand where the data is coming from and the lens they're looking through. They want to continue to have you think that we have some sort of shortage that we don't have. What we really have is a mismatch of properties. We've got overbuilt in these luxury premium price points, 750 to a million, and then we're underbuilt on starter homes under 450 because the builders don't make as much money at those price points. They make way more margins on these larger homes. So that's what we have. We don't have a shortage. We have a mismatch of properties, and the new construction just continues to stack. Look at this chart. It's incredible. These are new houses for sale by stage of construction, not started. How can you have a shortage when you have massive amount of backlog that you can actually build and start developing? And all of this is, of course, because we're in an affordability crisis, and it's getting worse. Buying a house now is less affordable than it was in the 2006 bubble peak. It's just as bad. And this is the huge problem. Wages have not kept up with inflation or housing prices, and the monthly mortgage payment on median household U.S. home relative to their wages. That's how they measure it. It's according to your wages. And I think that's a great way to look at it, because the majority of buyers are not buying cash. They're actually using a mortgage of some sort to be able to get into the marketplace. And that is what is holding back the entire market, is these interest rates around 6.5%. They've been very sticky at that price point, and they haven't come down despite oil prices coming down and other issues, because people are starting to view, and investors are starting to view, mortgage-backed securities as more risky than the treasuries. And so the spread has remained elevated over the last couple of weeks here, even though we've seen the 10-year treasury come down. And what we're seeing here is basically just this massive bubble. Okay, so this is what happens when the federal government creates zero interest rates, right? The Federal Reserve does zero interest rates for an extended period of time, and there's massive speculation by investors. Okay, so the U.S. home owner equity is 36 trillion. Now, a lot of people say, hey, this is the reason why housing won't crash. Well, this is actually the opposite. This is what happens. This is what it looks like when it crashes, right? You have record equity in 2006. People are saying the same thing. Oh, they have so much equity, there's so much cushion, whatever. Same thing here. We have so much equity, so much cushion, whatever. That's when things get sticky, because the people who bought from 2022 to 2025, 3 years of purchases, are going to be underwater because they bought at a really hard time in the business cycle. And so this is what's keeping people stuck, right? The sellers won't sell because they can't take that equity out. They don't want to lose their low interest rate that they've already locked in, and it's very difficult for them to move somewhere else. They're starting to see their prices soften, so they say, oh, I'll just stay put. The buyers can't buy because of the affordability crisis. They don't make enough money, and the prices are too crazy, and that's caused the transactions to just slow to the point of, we're near great financial crisis levels of existing home sales already, and the demand is extremely soft at great financial crisis levels as well. And so we expect this to continue moving forward until prices come down, and we're going to look at how much prices have increased, right? We're living through one of the largest bubbles in history through the real estate market. You can see we just had this massive home price appreciation, and we're way past the 2006 bubble at this point. This is inflation adjusted home prices. I don't know how anybody looks at this chart and says, hey, we're not in a bubble. And eventually we will have the mean reversion. It takes time. Real estate's an illiquid asset class, but it'll eventually happen on a wide scale. And it's going to start with the Sun Belt. It doesn't happen everywhere at the same time. But just looking at this chart, just ask yourself, or would you be excited to buy at this point in the market cycle? And part of the issue, again, comes back to the affordability crisis. The ownership costs have skyrocketed, and there's a lot of people that are starting to see short sales and foreclosures, especially here in Florida, because insurance, maintenance, and emergency repairs are not even considered usually during the home purchase process, but they've skyrocketed. Look at this: emergency repairs up 175, home maintenance 85%, insurance up 72%, property taxes, interest, and principal. Almost every metric that goes into housing has become more expensive, to the point where it's taking up 39% of people's annual bill to be able to afford it. Okay, so typically the rule is 28%, which is where you should buy. So we're about 11% over, and that's just an indication that we're just in such an unaffordable market that there's something that's going to have to give over time. And my guess is that it's going to be the sellers, because I don't see things getting better from here. I don't see interest rates really dropping that much unless we start to see employment cracking. But if we see employment cracking, you can't buy a house if you don't have a job. So that's also not a good thing. And obviously this is changing the way that people do migration, right? Instead of coming to the Sun Belt areas now because it's too expensive, people are going out Midwest. It also changes the way that people, live, right? For the percentage of adult children living at home, people are moving back in because it's so expensive with their family members, so they can save a little bit of money and try to get their life going, right? And It's very interesting because usually the young people are supposed to go out there and work and support the older generations. But right now it's the older generations that are supporting the younger generations in their old age, because the younger generations just don't have as much opportunity right now. And this is basically a consumer crisis, right? The parents are trying to get their children out of their own house, right? So 6 in 10 parents are helping their kids buy homes, is what the survey finds. A study done by Veterans United Home Loans shows that many commonly contribute between $25,000 and $100,000 more often as gifts. Now, if you're lucky enough to have one of those, thank your parents. I certainly did not have that type of gift in my family. We did not have the extra money from my parents to be able to gift me and my brothers money to buy a house. Congratulations if you are in that fortunate situation. Definitely take advantage of it and be very wise on your purchase. The worst thing you can do is take your parents' money, buy at the peak of the market, and then have the market just wipe that equity away. So be careful, negotiate, get with the top real estate agent in your market, and make sure that you have and your market is doing well and it's going to be able to survive and thrive long term. You need to look at real estate on a micro level in order to do that. Obviously, the median age of all home buyers has just gone bananas as well. It's up to 60 years old now. It used to be closer to around 30 years old. And so things are changing. The consumer is maxed out. It's taking longer for them to do everything, basically buy their first house, get married, have kids. They're putting off everything because it's so unaffordable. I think there was a study that came out that showed like the people who are married and have children under 30 has dropped over the last 40 years from about 50% down to 12%. And that is a scary statistic. So, society is changing because of the financial situation. I know a lot of people say, oh, it's not just financials. I would say probably affordability is the number one thing that impacts the majority of consumers. Obviously, the people who say the financials don't matter are people who have a lot of money, because I don't know anybody my age, I'm 35, my age, who are, having kids and not talking about money and how they're going to be able to afford even daycare costs, because daycare is super expensive. And even just having childbirth can cost up to 20,000 plus. And that's just like a normal childbirth situation. So, but look, we're already starting to see corrections across the board. Obviously, Austin, Texas is the number one that has corrected the most. It also boomed the most. So we're starting to see these boom markets that just went crazy. Now they're starting to revert back to normal, which is good and healthy. I think it's a good thing. I live in Jacksonville, Florida. It says that it's 22% overvalued right now, overpriced. The reality is that we're about 30%. So this chart, I'm not sure it's probably accurate in direction. However, it might not be by magnitude. But look at this, Indianapolis, Orange County, Chicago, Philly, Charlotte, Raleigh, Durham. These areas were like massive boom markets, from 2020 to 2022. Same with Atlanta, and they're still overpriced. It's just a matter of time for the financial gravity of these mortgage rates to pull the prices down. And it also depends on how much the construction was, right? If there wasn't a lot of new construction around there, they may still have a limited supply that is holding up prices. But eventually, again, over time, not saying 1 year or even 2 years, over 5 to 10 years, the financial gravity will pull through. It is overvalued. It is overpriced at this point in the market cycle. And we're going to start to see prices come down across the board. This will likely be a negative year for real estate. If you look nationally, it's 26% overpriced nationally, which is a scary thought, right? If you bought something that was 26% overpriced, and it was your largest financial investment, that's not really a good deal. In most cases, buyers have opportunity costs. They can go rent a similar house for much less than what they would pay for the monthly payment, and they wouldn't have to deal with the headaches of doing all the repairs and everything like that. So let's dig into the demand, because I touched on this briefly. Homebuyer demand remains near record lows. You can see that we're near great financial crisis levels of demand, simply just because of interest rates and prices being way too high. And this is, we don't have a seller shortage here. We have a buyer shortage. Okay. So the affordability crisis is absolutely in full swing. Home buyer demand is down 37% from the peak in May 2026. That's massive. Pending home sales are also down. So, right, there's not a lot of demand. The pending home sales have shifted downwards. Actually, here locally, we're seeing pending home sales down 24%. So the active inventory is up. The pending sales are down. Price cuts are accelerate. We see price cuts on like 40% of listings every week now, which is incredible and very good. Good thing. Homes are sitting longer. The builder incentives are stacking up and they're cutting. The mortgage applications are kind of just grinding along the bottom. Affordability remains like the worst ever, and we're going to the lowest level since 2009 for the pending home sale situation. And we have a buyer shortage. Right now, we have more sellers than we have buyers. I expect this gap to continue to widen until the sellers give up their prices, and then that will push the buyers back into the game. Buying at this point in the market cycle is often 50% more expensive than renting a similar home. This is a big story because we're also seeing rents come down. So renters have total power in many markets. If there's a lot of new construction, the buyers have complete power. Buyers, you need to be aware. You need to have an agent that's aware of what is happening in your market so you can actually take advantage of what is happening now. Now, I don't think all of the pain has actually happened yet. I think we're at the beginning stages of the pain. So you have to decide if you want to buy now and you're going to stay for the next 10 to 15 years. But if you're looking to sell in 2 years, I think it's a very risky bet in the majority of markets. Obviously, in Florida, we're starting to see basically almost every metro go negative now because we had such a boom. And now we're seeing, Florida had a big post 2020 housing boom correction. So we had this massive run up, right? Because of zero interest rates, mass migration. Then the Fed raised the interest rates and that pushed mortgage rates higher, and it caused basically the speculation to disappear. The problem with Florida specifically is that we have a very thin middle class. It's mostly not mostly, it's about 22% of people are retirees that come here and live here. But the middle class just doesn't earn enough money. The locals are completely priced out of buying in most Florida real estate markets. And the other issue is that you need a lot of income to be able to survive. This comes from Mike Green, and he says that 136,000 is the new poverty level of income because you could make 40,000 and get a lot of incentives from the government to survive. But if you make 136,000, you have all these expenses and all these taxes. So it's very expensive to live in many of the states, and the number one conversation is how do I save money on basically anything right now? And housing is the number one topic across the board. That's why you see the administration come out and constantly come up with ideas. Although Trump says that he does not want prices to come down, I don't know how he's going to create a better housing market if prices don't come down for the next generation. So it's something that's really, you need to think about, 10 years from now, who's going to be the next buyer of real estate, and will it be at the prices that we have today? Because right now we're seeing international immigration slow down. We're seeing net domestic migration slow down. You're seeing population growth slow down across the board. So who are going to be these buyers in the next 10 years for the house that you're going to buy today? It's an important question that you want to ask. And right now, the sellers are giving up. Okay, so they're taking their house off the market. We call this rage delisting or rage quitting, where sellers get very upset. They can't sell their house. They take it off the market and then they turn it into a rental, or they just stay put. So the same reason why buyers can't buy is the same reason that sellers can't sell. And what we're seeing is this movement towards accidental landlords, which is pushing rents lower, which causes the prices to actually go lower because there's just more options that the renters have versus buying, and that spikes demand even lower. So we're just seeing this kind of rolling period that just continues to get worse every single month that goes by. There's a lot of people out there who say, oh, I don't see it. It's not happening in my market. Cool. You probably live in the Northeast in Connecticut. But the majority of transactions actually happen in the Sunbelt area. And that is the major story in the United States. So you need to pay attention to what's going on for the markets that have the most activity. And we are seeing it happen, right? And because of this lock-in effect that we see with these people who had low interest rates, they don't want to give them up. We're seeing U.S. home turnover at the lowest rate that we've seen in decades, according to Redfin. So people are just staying put in their house, or they're turning them into rentals. They're not turning them over as much just because the numbers no longer make sense to do so. The other story here that's really sad is that even though we have the stock market at record highs, in a lot of asset classes at record highs, the index of consumer sentiment, the consumer does not feel good. And you need a strong consumer base for housing to survive and thrive and move forward, because you need a piece of demand. So if, they're loaded up with debt, the consumer's loaded up with debt, they're scared of their job loss from AI, etc., they're not going to go out there and make the largest financial investment of their life and buy a house. So the majority of people's financial situation does not look good, and it's getting worse actually every single month. Americans are notorious for spending basically every dollar that they have. And I think at some point their money will run out. And I think that's actually starting to happen. Sadly, I'm starting to even notice here in Jacksonville, you go to Starbucks and you see the person handing you your drink is like 75 years old. They didn't save enough money. Their house isn't worth enough. Maybe they didn't benefit from the massive boom that happened out there. So we're seeing consumers just get absolutely crushed. And we obviously had a massive period of inflation, and prices are not really coming back down. They're still actually moving up. And we'll have to see what the Fed says, because I know that the Fed came out with their last dot plot, and there's some banks out there that expect three rate hikes this year by the end of the year based on what they're seeing. Of course, we have no idea where things are going to go with this new Fed chair, so we're going to have to pay attention closely, and I'll be keeping you updated on this channel. This is the one chart that I want you to take away before we log off today. So thanks for joining with me. And if you need a top agent in your market, send me an email. If you want advice on your situation, send me an email. I always respond to every single email. I try to get back to people in 24, 48 hours. But this is the one chart you really need to think about. We've had falling mortgage interest rates, the 30-year fixed mortgage interest rate, for 40 years. It's been dropping, and that has caused asset prices to skyrocket. The question I want to ask you is, what happens when they stop dropping and they go the other way? What happens to asset prices when they're fighting against that financial gravity in the higher payment? Because we live in a payment economy. And that will probably give you every clue that you need to know. Of course, the government's going to continue to spend and print and all this stuff. We're going to have inflation. But what happens when you have these higher rates and things are no longer affordable? Prices will have to eventually correct at some point in time, especially as builders have overbuilt in specific Sunbelt markets. That's going to drive prices lower. And if migration trends continue to sharpen and change dramatically, you really could see this turn from not just a correction and into a crash in specific markets. So look, I'd love to hear from you. Comment below what will happen next. Give me what you're seeing on the ground in your market, where you're coming from, what brought you to the channel, what information here was something that you didn't hear before, didn't see before. I appreciate you following and look forward to staying connected with you. As always, you can follow me on Substack. I talk about things there I can't talk about here on YouTube. And you can go to my website, movewithmomentum.com. Highly recommend you check that out. You can actually do a neighborhood search for Florida now, where you can search by neighborhoods and get neighborhood market intelligence. So check that out. Let me know what you think about it as well. I'm expanding this website dramatically every single day and would love your input. Thanks so much for watching, and I'll talk to you soon.